AI can process logic, but trading isn't just logical, it's also psychological. The same people that worry about whether AI is going to take over their trading are the same people over 15 years ago that used to worry about algorithms. Like, they're always worried about the potential of something. It's the same type of individuals that don't buy Bitcoin because they believe that Bitcoin might be worthless in the next 50 years. Yeah, but within that time, Bitcoin might have gone to £1 million per coin by then, and you've not benefited from the whole process. What I'm trying to say is that when you live in this fear of thinking, no, what if this happens? What if this happens? It's actually a bit of self-sabotage in disguise, because you don't know that that would happen. And even if AI could win, so to speak, you got bigger problems than your ability to swing trade intraday. You got much bigger problems in the world. We all have. So I don't think that would ever happen. And I'll tell you why. Even if someone had an AI that it could do that, what government or governments do you think would approve it? Even if they cracked it, how would that function exactly? What you're referring to, what most of us are, if you're thinking about AI, are there systems that, plot on a few lines to show you where the institutional traders are? And that's always been the case. But the reality is, relying on the AI to do that is just pure laziness. The reason why people can be successful in trading, because it's a zero-sum game, and there are imperfections in the market, and things are changing. There's variable change. Like, there will be a time in which that, typically, what do people do when there is war? They go to gold, right, for a safe haven. There were times in which that the same rate of people going towards gold in a war-based crisis wasn't as much. I'm not saying they'll never not do that, but it wasn't as much. There's a little bit of variable change. Big institutions and funds, they might be making decisions for different reasons, and then they could change their mind halfway through their strategy. Who knows? There is always variable change, and that's always existed, which shows you how much of an imperfect market that we have. So even if it was to be the case, you're talking like 5, 10, maybe even 15 years away from that being the case. And then guess what? If it did, we would adapt, because there's always an edge. There's always an upper hand. If you really think about it, if someone else is using it, it means that you can use it as well. So there will be a way for you to gain an advantage. So all you do is adapt, you evolve, and just make sure that you can include it at the same time. But that's always been the case. So I just think this term AI, because it's moving at such a rapid pace, people naturally live in a bit of fear. But the reality is, if you approach life that way, you'd never start anything. And then you'd look back in so many years going, oh, why didn't I just try and learn that skill? Because I worried about potential possibilities. It's not a way to live. So I'm currently long on Kiwi Yen at the moment, but I thought I would show you what I mean when I would talk about what I think AI might do, or what it could do in regards to trading. So this is running nicely at around 2.8-ish%. Let me show you this on pound CAD. So let's say, for example, AI comes into the market and you're wondering, right, what that's going to be. Remember, I spoke to a big institutional trader who has their own software for AI. And I was speaking to him, and he was in the industry for like 22 years. And he said to me, AI is good, but it's still lagging behind. It can give you an opinion. And basically what it boiled down to, because we was going back and forth as to like how I trade, how he trades, and he essentially showed me the equivalent of this. So we'll take pound CAD as an example. So let's say we plug in this AI, and this AI now can tell me where the big institutions and funds and banks and bigger players are stepping into the market. I'm like, right, so then it will show me on the weekly and on the daily candle. He said it would be the equivalent of going, right, at major resistance points, you're going to see certain type of candle shape formations that would represent bigger players stepping into the market. So then we would have something like this on a weekly or the daily that we're getting a turnaround. So imagine you plug in your AI, and I know there's AIs that tell you, where to buy, where to sell, but look, they don't really last, because if they did, the market would be cracked, and then no one makes money, does it? So we know it can't be that accurate. But what you have is this. You've got break of high, we then tap the high, wick through it, and then we start to create a new high. That high gets broken, so we move that up as follows, and eventually we go from this high to this high, and we finally take it out, and then we get our reversal candle. So what I'm seeing from what me and him spoke about, and this was actually a couple of years ago, it's just going to make you lazy. It's actually going to make you less competent, and I don't really see where you gain an edge here. Where you gain an edge, and where this has always been tried and true, this is why I'm never a fan of 100% mechanical trading, is because it's too rigid. There isn't an edge in a move that every single person can make. Where's the edge? Like if I know what you're going to do, like let's say for example, you got the AI, I've got the AI. Is it AI versus AI now? If I know what you're going to do and why you're going to do it, then there is no edge, is there? The edge happens from a situation like this, where I can interpret, right, so you've got this high, you've got 1, 2, let's say someone who didn't really understand the mass psychology of the market, they'd be selling here, selling here. Let's say you're just a pure resistance trader. You're doing this, building this range, and I know full well massive moves in the market happen once a significant high or a low is broken. So I'd be waiting for that. But what a coincidence, you have it in a phase 1, a phase 2, a phase 3, which is so typical. Now you could say, well, an AI can predict that as well, but it's not rocket science. So of course it could predict that, but you're not gaining an edge by the AI telling you a break of a high and then it's closed back in. This is where bigger institutional funds can get involved. You're gaining an edge from your interpretation from higher time frame to lower time frame. Now, even if a AI can, I don't know, can perform a simulation of the same sort of thing, we've already had it with algorithms. We've already had it with some of the most intelligent people that have built these bots. What do they have to do? They always have to tinker with them. They always have to tweak them. You're better off being the individual that can interpret these scenarios better. So you have a mechanical thought process all the way through. It's still methodical, but you get to interpret the scenarios to go, do you know what? I'm actually going to mitigate the risk by using this method, or I'm going to stay out of this trade because of this criteria. Where when you're so rigid, it is just boom, 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 boom. And when it doesn't work, it really doesn't work. You can't survive the prop firm rules and you lose all your funding. So I really want you to think deeply about what actually happens to the world, even if that was the case. But I also want to give you something that's going to be way more useful. So what is that? Hybrid trading. You're going to hear me talk about this a lot. And this is the first time you're hearing about this. You've not heard about hybrid trading before. It's because most people are in a bracket of, I'm a swing trader, or I'm an intraday trader, or I'm a session trader, whatever it is. What you need is something way more dynamic. So let me just show you on PoundCAD how many entries and what that would look like. So you need your background positions, you need your intraday positions, you actually do need your scalping positions. I'm not saying you can't scalp, I'm saying that can't be your only method, because over a 10-year span, very, very few people can ever make it scalping profitably in the long run. It's a reason why the top institutions, it's a reason why the top traders in the world and every podcast you've ever listened to always say, very, very rare that you'll meet someone who's a scalper who's been in this business for like 10, 15 years and consistently profitable. Why do you think they say that? These are some of the best and they can't make it work, but you think that you can just because you follow some random guru showing you profit payouts. The exceptions don't define the rule. So this is how it would work. You need higher time frame positions backing your lower time frame positions. So let's say, for example, and I'm going to do this rough, I would be getting in as a daily move here, and I would be in roughly, I'd be there anywhere between 30 to 35. I'm going to go 35 on this one. So 35, and then I would have 3 key targets here. So I'd have target number 1, target number 2, target number 3. So let's say we aim for target number 1 first. That's at 8.7. That's your first trade. So that's your first key target. So we'll move that to one side for a second. And then we also have on the 4-hour time frame. So don't forget about that. The 4-hour time frame, we have our second move, which is there. By the time you're in and above. So for target 1, you've got 6. I'm gonna move that out of the way. And then on the 1-hour time frame, you have your beautiful. So let me just show you there. Just need to fib it to get the exact entry. Okay, cool. So what does stop be 30-ish again, so 33, 32. And then again, target 1. So 8.5. I'm putting on all of the entries. You're not going to get every single entry, but I'm putting them all on now. And then I know there was one because I missed this trade on the 15, which was there, 15 and the 5. And I'm just putting this on rough. And let's say we aim for target 1 again. And there was another one on the 1 hour, but just forget that for now. It was there. Actually, no, we're going to do it. So 1 hour time frame. So what have we got here? Quite a few, actually. So you have your daily position, your 4-hour, your lower time frame, your lower time frame, and your lower time frame. So you've got to look at the duration. So you've got 8.7, 6, 8, 14 and a half, which is insane. And then another 4.9, so pretty much 5%. So look at all that percentage all the way through. Right, so 5, 20. Yeah, so way over 40%. So you've got over 40% of profit in one single run. Now, this is where I think scalpers go wrong. So let's say within that, you was in and out a few trades where you're like, right, I'm in on the 5 minute, the 1 minute, and you actually picked the direction correct, but you just got wicked out, or you went through some drawdown where there's a bit of slippage, spreads, whatever the reason is, you've now gone down a losing streak. If you was down -6, but you just had just one of these, because I'm not saying you're going to get every one of those moves, it's impossible, but let's say you just had one of them and you had an awful streak where it was like loss. Let's say you are like -6. If you're -6%, but you just got one hedged position at 8.7, you're still profitable. But if you don't have your hedged position because you've been taught that you either need to be a swing trader or you need to be a scalper, and that's your identity, well, then you're going to fall short, aren't you? Because there's usually every variation of the trade. Like if we look at a daily run, so if I go back to the daily, let's actually have a look and we can count, right? So the end of close of that, so you've got 1, 2, 3, 4, 5, 6, 7 pretty much, right? So a week, 7 days. So you're going to have some trades that you hold for 7 days, some trades you hold for 7 minutes, some trades you hold for 7 hours. Now, it really doesn't matter. What matters is if every single trade was a 7-day hold, that's also not good. If every single trade was 7 hours, that's also not good. You need to know how to play every single scenario. And every single scenario requires a different level of thinking. So you're not always going to do that on the same account. But anyway, I'll go through this in funding mechanics. Everything is clear. You need to know what you need to do. You'll know how to maximize on prop firms better. You'll know how to stack capital better. You know how to move towards a bigger personal account better. But it's really about making sure that you also fly under the radar. So things are going to be changing. Like you're worried about AI, you should be worrying about completely different things. You should be worrying about your lack of emotional control. You should be worrying about the people that you're following that are leading you down the garden path. Now remember, the same people that you follow are the same people that change their strategy twice a year, or they tinker with their edge. Like if you have to tinker with your edge, let's be honest, if you have to tinker with your edge every year and a half or every couple of years, you don't really have an edge in the first place, do you? Because that already tells you that it's not really battle tested over 10 years of data. Now you might be saying, Mark, well look, sometimes things do change. Yeah, granted. But if someone is tweaking their edge every 2 years, it means they never had an edge in the first place, because the probability of you having an edge that stops working and then you finding a new one and then that one also stops working within a couple of years is like so unlikely that it's more possible that you never had an edge to start off with, and the data that you tested was too short term, so no wonder you're not profitable. What you need is a hybrid model. What you need is a robust system, and I tell you this right now, and you heard it here first, especially next year, and if you want to get prepped, you got to get prepped now. Next year, this whole one pair rubbish, that'll be a thing of the past. I'm telling you now, you can clip this video in a couple of years. I said it before. I said it with the 2-pip stop people. I said this years ago. Go and clip my old videos. You focusing on a 2-pip stop, unsustainable, it's not going to work, and you're going to see people shift. What did they do? They shifted from 2-pip stops to now aiming for 2-to-1s. So they've gone from doing stupid risk, ridiculous stop losses, to now ridiculous profit targets. Which one is it? Like, they don't know whether they're coming or going, and this is why you can't take these people seriously, because they're not strong in their convictions. They don't know who they are. They're figuring it out as they go, and that's why they think their edge suddenly isn't working, because they never had one to begin with. You've got to make sure that you're auditing the right people. You need to be able to plug and play that system and go, has this worked for the last 30 years? I'm not saying you can never tweak or refine it to a degree, but to completely change it up, to go from I trade one instrument and now I trade 2 instruments and now I go back to one. That's stressful. Nobody wants that. And this is why you need variation. There is also an element of oversimplification. So for example, if you just simplify for the sake of simplifying it, that doesn't mean that you gain an edge, because then it's almost too simple and it's too basic. You need an element of no one can just figure this out that easily. Otherwise, it can just be reverse engineered. That's why your model should be 95% mechanical, or you could say 97, right, roughly around that, and then only a very small percentage of it should be discretion. And you know what you're going to see as well? The word discretion, that was a bad word, wasn't it? People just hate it. Like, oh, discretion. They're scared of it because they don't want to use their brain and think, not realizing that discretion is actually the key to all of this. Because if you have discretion over someone that doesn't understand how to do that, you've got an edge over them. And that's what this game is. Because if I know what you're going to do every single time, it can just be reverse engineered. And then if you are worried about AI, you should definitely worry about AI because you're too mechanical. Where my system has got a mechanical approach, but yet that very small percentage, I can interpret, right, I'm going to stay out the market. I'm going to, and this is not out of instinct, this is actually like metric criteria. I'm going to stay out of that trade for X, Y, and Z. Or I'm going to enter this one because I'm already in profit, so I can afford to take something slightly higher in risk. That is going to give me and everyone in Falcon a much greater edge than something that is so rigid that doesn't last anyway. So I want you to have a long, hard think about this. I know why you get sucked into 100% mechanical systems, because you think that it removes emotion. It doesn't. The irony is these traders are the most emotional. Like you telling me that if you're a minus 7% drawdown, even though it's mechanical, that you're happy, that there's no emotion there. Like it's rubbish. Like you've lost your funding. The system that you've got is not going to survive prop firm rules, and deep down you know it. So look, the penny is dropped. The show is over. Next year, you will see more of a hybrid method trading. And I think the problem is with most systems is that they won't be able to achieve it because their system wasn't dynamic enough in the first place. This is my opinion. I've been trading for 18 years. I back this, I stand by this, and there's a reason why we've built 10 mil on our in-house fund by doing this. This is only going to get stronger and stronger. You need a hybrid model.